Welcome everybody to Quantacast 16. We're getting close to 20. We're here today to talk about building 212 Darlington Drive in Yatala, southeast Queensland. Stacey, you're always on my right. Welcome.
Thank
And
you.
Andre, our head of transactions. Welcome, Andre. He doesn't like that. He likes capital transactions. Today we're here to talk about this southeast Queensland industrial investment. We're very, very pleased to be bringing it to market. We've had an overwhelming response to our expressions of interest. And I know why. We've got a sort of 3 to 4 year investment horizon, so we'll start to exit this investment in year 3. We're looking to 17% IRR, which is easily understandable and not complicated, as we have seen from our competitors at times. So that gives you a total equity return of 1.6, $1.60 for every dollar invested. We're buying in a precinct that's under 1% vacant, and we think these particular tenants are doing well for themselves because they might be sort of 13, 14% under rented. So, Andre, on top of all of those great things, tell us why you're so excited about the investment.
I think it's a very compelling investment opportunity, Tim. So it's a modern concrete tilt, high clearance shed in Yatala, which is in the M1 corridor, situated between Brisbane and the Gold Coast. Dual tenanted to IFC Mining and Rococo Cosmetics. So one is a mining group based in the Netherlands. They do a metallurgical testing, and they also do engineering, design, and manufacturing installation. Rococo are a Australian-based skin company. They've been listed on the Australian Financial Review's fastest growing Australian businesses in 2021, and most recently reported a turnover of close to $6 million. They in that shed, they do manufacturing, distribution. They do a lot of distribution out to the US and international markets, so predominantly US and Australian-based operations.
Yeah, we went out to look at it, Stacey. Both very busy, but particularly IHC Mining, as we were well informed by the lady at reception there, that please watch where you step because there's stuff everywhere. What was your first impression of both tenancies?
Much busier than I had anticipated, to be honest. An incredibly modern looking facility, exceptional location, great for logistics. So lends itself very well to a range of different types of businesses to use the site, but incredibly well suited for those that are there. The office component as well was modern.
Amazing modern.
Yeah, much nicer than you expect to see in an industrial facility, but not overs. You're not expecting that great office in an industrial building, but still really nice accommodations, plenty of space, and the tenancies were really well utilised by both tenants.
Agreed. Then look, this whole IRR and investment thesis, I guess, Andre, talks to the tenants and the rent they're paying. Can you speak to that a little bit more?
So Yatala is a very strong market, Tim. Between the tenants, because their leases were signed in the early 2020s, they've got an average market rent of $157 a metre. Leases out in that precinct are generally between $180 and $200, with the most recent lease deal done there at $230 a metre. Yatala presents with exceptionally low vacancy. It's at a 0.9% vacancy. For context, Brisbane sits at 3.9%, and the Trade Coast region is at 4.6%. So and Gold Coast, I think, is around 2.5%. So incredibly tight vacancy rate out there.
All he's doing is promoting Queensland, this bloke. Andre, what about whale-wise? What's happening with the whale there?
So between the two tenants, the whale's 1.4 years. There's a lease that expires in December 2026, which is with IHC. They're in their option window at the moment. If they exercise their option, which is for 4 years, that would extend the whale
At 3.5 or something. And it looks at the moment they're very engaged with renewing, and I think we've seen some correspondence from the general manager in Australia. I think we've got a renewal out to board approval. So that's looking very positive for them to stay on for another 4.
Party who'd actually put an offer in prior to us, that contract actually fell over because that tenant didn't want to leave.
The way that this transaction came about was it was an on-market campaign, which was in February, March this year. There was a purchaser above $12 million, but they were an owner-occupier, which wanted to occupy that IHC tenancy. That they had terms agreed, and then the owner went to the tenant and asked, "Can you please provide vacant possession?" And they said, "Well, no, we want to be here." So that's just taken a little bit of time to get renewed because their head office is in the Netherlands. However, we're expecting that they'll renew.
Okay, great. And our purchase price is $12 million with equity requirement of $7.4 million.
That's correct.
And what are we looking at? I think I said first year distribution 6, second year 6, 6.25 in the third. And that's when we start to realise some of the uplift in rents because Rococo becomes up for renewal then.
Yeah,
and that's not an
2020.
option, it's a renewal. So You're thinking we turn their rents if we can, or if we need to replace them, and just on the replacement of any tenants in this particular precinct, that seems something you're very comfortable with, even if tenants weren't to renew. Is that correct?
Yeah, that's correct, Tim. So as I said, the vacancy rate's less than 1%. So supply out there is constrained. There's a lot of construction going on out in that precinct. However, they're targeting rents of above 200 very comfortably. So a very strong tenant demand market out there. The distribution profile is correct. However, really, this is a total return play. So we're targeting a 70% IRR with the disposal at the end of year 3 with an equity multiple of about 1.6.
So part of that 17%, what are you disposing out as a year passing yield, Andre? You're buying at 6.71 and disposing out.
Yeah, so we've looked at the market. A lot of sales in that area are anywhere between 4.5, 5.5, up to 6. We're targeting a 6% sale cap rate at the end of year 3. In combination with the reversion of those rents to market levels. And we're currently purchasing that asset at 6.7%, so exceptionally good buying.
So on due diligence, things are tracking well, Andre. How's the tech DD and how's the valuation situation?
So we've received valuation support based on the sales and the leases that they provided, and the feedback from the valuer is that we're buying it very well. Tech due diligence has come through. There's a bit of end of life AC, which is not a huge cost, but otherwise structurally, the roof, the building, or the services they present perfectly fine.
So a really different product, Stacey, for our investors, where it's very much a capital play, short term hold. What does that do for the trust structure?
So this one, we've dropped it back to a 5-year. So we've got a 3-year projected horizon, but a 5-year term. We always like to give ourselves that bit of flexibility. So we have the flexibility should we need it, so we aren't forced to make a decision that isn't in the best interest of investors. But target is the 3 years. And, as Andre said, our IRR's calculations have been done on very defendable projections. We haven't pushed the needle on those to try and make that look something that it's not. And also, there's some other areas of potential upside that we haven't factored into that. So, for example, you mentioned this is building 2. So there is a building 1. It does form part of a community title scheme, but very importantly, they are 2 standalone buildings to look at. It looks like your average freehold. The reason that's been done is because there's underground services that otherwise might have been a bit of a mess of easements. So the community title scheme is put in place to protect the services that are running underground and a bit of access. Being a simple scheme of 2 lots, it is something that isn't too challenging to unwind. And we understand that the neighbouring owner is quite a savvy property owner, and there is quite a compelling case from a value perspective in unwinding a community title scheme where it's very simple to do so, where they are standalone. So that's something that we're going to explore, and we're going to have discussions with the neighbouring owner and see what their appetite might be to at least explore it further, and we'll do that as due diligence progresses, but none of that is factored into anything that Fred's talking about in terms of returns.
Thanks, Stacey. It's been a phenomenal response so far. It's our strongest for the last 3 years, so things will move quickly. So if you are interested in investing, I suggest you get on to Dave and Brock and get your entity sorted out, ready to go. But I'll thank Andre for being here. Thanks, Andre, for all your information.
Thanks, Tim.
And again, thanks to Stacey, and we look forward to bringing you another Quantacast soon.